So picture the scenario for a second. You are staring at a stock chart, and, well, the line is just going almost vertical.
Right, like an absolute parabolic uptrend.
Exactly. It just crossed into a brand new 52-week high,
Yeah.
and the momentum feels, completely unstoppable at this point.
Yeah.
But then you glance over at the professional Wall Street analysts, and they are basically frantically waving these yellow caution flags. And when you dig into the trailing financials yourself, honestly, they look pretty grim.
Oh, they look terrible.
Right. So you have to ask a really high-stakes question here. Is this an incredibly undervalued turnaround play that's finally finding its legs? Or, is it just a classic value trap waiting to snare retail traders who are late to the party?
It's like the ultimate market dilemma, isn't it?
It really is.
When the rear view mirror shows you a multi-car pileup,
Yeah.
but the windshield shows this wide open highway, like, which view do you actually trust with your capital?
And today, we are taking a deep dive into a company that embodies that exact contradiction. We're talking about Intel Corporation, ticker symbol INTC. Yeah. As of our focus date today, which is April 10th, 2026, the stock just closed at $62.38. It is really pushing new boundaries right now.
Pushing boundaries is a good way to put it.
So we are going to unpack the mechanics of, what is actually happening under the hood here, the complex technicals, the turnaround strategy, the whole thing.
There's a lot to cover.
There is. But before we get into these unprecedented new partnerships, we do have some required housekeeping. You need to like this video, subscribe to our YouTube channel, and it is compulsory that you leave your comments and feedback down below.
Yes, definitely.
Tell us what you think about this run, because the divide in opinion out there is just staggering.
It really is. And let's also establish the ground rules right up front.
Yeah.
This deep dive is just a natural, objective debate of the provided data.
Right.
We're looking at the market signals and the underlying mechanisms driving those signals. We're synthesizing the numbers and the narratives so you can understand the landscape. But, and this is crucial, this is absolutely not financial advice.
Right, totally. Okay, so let's unpack this. To understand why some people are screaming buy from the rooftops while analysts are practically begging investors to sell, we have to start with the financials.
The massive disconnect, yeah.
Exactly. The disconnect between Intel's historical financials and its current price action. Let's look at the trailing 12-month numbers. On the surface, the picture is incredibly rough.
Brutal, even.
Yeah, trailing revenue is sitting at $52.85 billion, which, sounds substantial, but it is entirely flat.
Stagnant.
Completely stagnant. And when you move down to the bottom line, it gets worse. Net income is sitting in the red at negative $267 million.
Ouch.
Right. That equates to a negative net margin of 0.50% and diluted earnings per share of negative 6 cents.
And, the underlying mechanism causing that negative net income is really what you have to pay attention to.
Okay, break that down.
Generating $52 billion in revenue, but failing to turn a profit. That means the operational costs and the massive capital expenditures are just suffocating the margins.
Right, they're spending so much to build.
Exactly. And when an operation of that scale isn't generating positive net income, it immediately bleeds into the balance sheet. Right now, Intel is carrying a total debt load of $46.59 billion.
Wow.
Yeah, and that's against $37.42 billion in cash. So you're looking at a debt-to-equity ratio of 37.28%.
I actually want to stop on the cash flow for a second because this is wild. The levered free cash flow for the trailing 12 months is negative $4.5 billion.
That's a huge number.
It is. And for anyone who, isn't staring at balance sheets all day, levered free cash flow is essentially the cash a company has left over after it has met all of its financial obligations.
Right, including the interest payments on that $46 billion in debt.
Exactly. So a negative $4.5 billion means they are burning cash at a terrifying rate just to keep the lights on and the machines running.
It is a totally critical metric. When levered free cash flow is deeply negative like that, a company is effectively eating into its cash reserves.
Or taking on more debt.
Right, just to fund its operations and investments. It's simply an unsustainable state over the long term.
Right. So if you only evaluated this company based on those trailing numbers, you would logically assume this stock is cratering. But the stock is completely ignoring that rearview mirror.
Oh, completely.
It has surged roughly 70% year to date. It bounced all the way from a 52-week low of $18.17 to this recent high of $63.39.
Which is an incredible move.
It really is.
Yeah.
How does a company burning $4.5 billion in cash see its stock price nearly quadruple from the lows?
Well, because markets are forward-looking mechanisms. Right. They rarely price an asset based on what a company did 3 quarters ago.
Okay, fair.
They price an asset based on what the company did yesterday and what that implies for tomorrow. And yesterday specifically, the fourth quarter showed a profound structural pivot.
Ah, yes. The Q4 numbers. They are basically the linchpin of this entire bull thesis, aren't they?
They really are. Despite those terrible trailing averages we just went through, Q4 was an entirely different narrative.
How so?
Well, adjusted earnings per share actually beat expectations, coming in at 15 cents. But the real showstopper, especially considering our conversation about cash burn, was the free cash flow.
Right, the flip.
Yeah, it flipped from a negative $1.5 billion in the previous year to a positive $2.22 billion in Q4 alone.
That is just a staggering turnaround in cash generation. It forces you to completely reevaluate the whole picture.
It really does.
The way I view evaluating Intel's trailing financials right now is it's kind of like judging a sports franchise based entirely on last year's disastrous last-place season.
Okay, I like that analogy.
You know, you are looking at the terrible win-loss record, but you are completely ignoring the fact that management just fired the old coaching staff, overhauled the playbook, and made high-stakes off-season trades.
Right.
The scoreboard from last year looks awful, but the team on the field right now is playing a totally different game.
Exactly. The market is pricing in the new roster and the new playbook. That transition from deep losses toward recovery, specifically as they begin scaling their foundry business, is finally materializing in those Q4 numbers.
Which brings us to a major narrative friction point. Even with a good Q4, a 70% year-to-date run is an aggressive repricing.
Extremely aggressive.
So I have to ask, how exactly is this price moving with such velocity, and more importantly, who is driving it?
Well, if we consult the technical breakdown, the charts are reflecting extreme bullish momentum right now. The stock is currently in a definitive strong buy alignment based on its moving averages.
Okay, let's hear the levels.
Trading at $62.38 places it well above its 50-day moving average, which is sitting down at $54.34. And it is miles above its 200-day moving average of $47.33.
And just for context for the listener, when a stock is trading that far above both its medium-term and long-term moving averages, that is the textbook definition of an established, aggressive uptrend.
Correct. And the velocity of that trend is supported by the MACD, the moving average convergence divergence. Right.
It is currently sitting at a really bullish 2.53. The MCD measures the relationship between two moving averages of a stock's price, essentially showing us the speed and strength of the price change.
So it's moving fast.
Yeah, a reading of 2.53 is highly positive. It confirms that strong momentum is actively pushing the price action forward.
I want to highlight something crucial here, though. You might assume this is just a retail-driven meme rally, like a bunch of everyday traders piling in just because the chart is green.
Oh, definitely not.
Exactly. Because when you look under the hood at the options data, you see a completely different story. The order flow reveals aggressive institutional buying.
And smart money.
Yeah, we're seeing large concentrated call blocks. These are institutional whales placing highly leveraged bets that this stock is going to continue its parabolic run.
However, this introduces a pretty severe technical complication. Parabolic moves, even those driven by institutional call buying, rarely happen in a straight line forever.
Right, gravity usually kicks in. The mechanics of the market demand equilibrium. And there is a glaring warning sign flashing on the dashboard right now regarding short-term exhaustion.
I'm looking at the 14-day RSI, the Relative Strength Index, and it is currently sitting at 73.3. Correct me if my interpretation is off here, but isn't anything over 70 basically screaming that this stock has run way too hot?
Your interpretation is spot on. The RSI is a momentum oscillator. It measures the speed and magnitude of recent price changes to evaluate overvalued or undervalued conditions.
Okay.
When an asset crosses the 70 threshold, it enters overbought territory. Mechanically, it means the buying pressure has been so intense and so rapid that the asset has likely overextended itself relative to its intrinsic near-term value.
So the buyers are just getting tired.
Exactly. Buyers are becoming exhausted. It heavily suggests this parabolic uptrend needs a cooling off period pretty soon.
So if it takes a breather, where do the buyers and sellers actually meet? Let's map out the key levels.
Okay, let's do it.
On the upside, we have immediate resistance right at that recent high of $63.39. If it manages to chew through that supply, the next barriers are psychological round numbers, so $65 and then $70.
Yep, those are the targets.
But if gravity takes over because of that overbought RSI, where's the floor?
Well, if a pullback initiates, The first major structural support level to watch is $58.50.
Okay.
If the selling pressure breaks below that, the next safety net is the 50-day moving average, which, as we noted, is at $54.34.
Hmm.
Moving averages often act as dynamic support in a strong trend.
Right. And if things get really ugly.
If we see a severe macro-level correction, the Fibonacci 61.8% retracement level is situated all the way down at $46.12.
Oh, wow, that's a drop. Let me stop you there because this next part is what truly baffles me. We just established that the technicals are surging, the moving averages are incredibly bullish, and institutional whales are actively buying massive call blocks.
Yeah.
So why are the professional Wall Street analysts, the people whose entire job is to model this company, acting like a complete wet blanket on this fire?
The juxtaposition is severe, I'll give you that. If we review the analyst ratings, the consensus across Wall Street right now is just a cautious, neutral hold.
But the rating isn't even the shocking part. The average price target from these professional analysts is $48.72.
Yeah, that's a tough number to swallow.
Think about the gravity of that number for a second. The stock is currently trading at $62.38. The consensus Wall Street target implies a 22% downside from current levels.
A massive haircut.
Now, the range is incredibly wide, spanning from a deeply pessimistic low of $20.40 all the way up to a high of $76. But that 48 average is just heavily anchored downward.
That wide variance, from $20 to $76, tells you everything you need to know about the current forecasting environment.
Nobody knows what's going on.
Basically.
Yeah.
The analyst community is deeply fractured on how to actually model Intel's future cash flows.
I have to push back on the analysts here, though. I'm looking at this dynamic and thinking, if the options market is showing aggressive institutional buying, why are the fundamental analysts forecasting a 22% crash?
Well, there is a reason.
What is the specific fundamental anchor dragging their models down? It can't just be that overbought RSI indicator.
No, it isn't just the technicals. The bearish models are driven by a very tangible, fundamentally negative signal regarding the immediate horizon.
Okay, what is it?
Intel's Q1 2026 revenue guidance came in at only $12.2 billion. That figure is noticeably below what the analyst community had previously modeled. Wall Street absolutely despises when guidance comes in light, especially during a capital-intensive turnaround. It introduces doubt about the execution timeline.
And because of that lower guidance, the short-term outlook anticipates consolidation, meaning instead of rocketing to $70 or crashing to $46, the expectation is choppy sideways trading.
Yes, very choppy.
It is likely to bounce around between that $58.50 support and $61.50 resistance, while the broader market digests that lower guidance and waits for proof that management can actually execute.
Precisely.
Yeah.
And, it is worth noting the internal optics here. If that light Q1 guidance was indicative of a failing turnaround, you would expect corporate insiders to be running for the exits, right?
Yeah, dumping shares at a 52-week high.
Exactly. But they aren't. Recent insider activity shows zero panic selling.
Interesting.
Instead, the focus has been on corporate restructuring. Specifically, new executive appointments to lead the legal and human resources divisions. They are fortifying the administrative infrastructure for a long-term build, not cashing out for short-term gains.
Which leads us directly into the core debate of this entire deep dive. This conflict soaring momentum fueled by institutional bets versus cautious analysts pointing to weak guidance forces us to answer the ultimate question.
Is it undervalued or a trap?
Exactly. Is Intel truly an undervalued giant preparing for a historic renaissance? Or is it a carefully disguised value trap? Let's evaluate the downside risks first. Why do these fundamental analysts believe retail traders are walking into a trap?
Well, the value trap argument is anchored in those trailing metrics we discussed at the beginning. By traditional valuation standards, Intel is egregiously overvalued right now.
Because of the PE ratio, right?
Yes. It is currently sporting a price-to-earnings ratio of negative 770.61, which is a direct result of those recent net losses. Retail traders frequently get trapped in these scenarios because they buy the momentum of the chart and they completely ignore the fundamental gravity of the valuation.
And we can't ignore the execution risk either. It is a sword hanging directly over their heads.
The execution risk is colossal. The entire bullish thesis relies on Intel successfully pivoting its foundry business.
We probably need to define what that actually means for them.
Good point. Historically, Intel designed and manufactured its own chips. The foundry pivot means they are now trying to manufacture chips designed by their competitors, attempting to rival companies like TSMC.
Which is not cheap.
No, building and operating semiconductor foundries requires immense, sustained capital expenditure. We are talking tens of billions of dollars. If their manufacturing processes hit a snag, or if they fail to secure enough external clients to justify those multi-billion-dollar factories.
The resulting volatility could absolutely crush late-to-the-party retail buyers.
Completely crush them, yeah.
It's like a high-wire act being performed while carrying anvils. Okay, that is the terrifying side of the coin. Let's explore the undervalued argument, the bull case.
Let's do it.
Because if management actually pulls off this tightrope walk, the upside potential is staggering. The best-case recovery scenario relies heavily on the future, specifically the year 2027. That is the target for their highly anticipated 18A process node.
The 18A node is basically the technological holy grail for Intel's manufacturing ambitions.
How small are we talking?
When we discuss 18A, we are talking about shrinking transistors down to an atomic scale, literally measuring in angstroms. Smaller transistors mean more processing power and vastly improved energy efficiency.
Which is the lifeblood of modern AI data centers.
Exactly. If Intel hits those 2027 manufacturing targets with the 18A node, they reclaim industry leadership. Suddenly, those billions of dollars in trailing losses look like brilliant, necessary investments, and today's valuation looks incredibly cheap.
And it isn't just theoretical hope keeping this bull case alive either. They have tangible catalysts that prove the industry believes that they can do it. They are securing game-changing partnerships.
Massive deals, yeah.
Let me run down this list for you, because the scale of these deals is profound. First, they secured a multi-billion-dollar custom AI ship contract with Amazon's AWS.
Amazon AWS is the largest cloud computing provider on the planet. Securing their business is just a monumental vote of confidence in Intel's manufacturing roadmap.
Totally. They also announced a foundry partnership for Tesla's Terafab project. And the absolute cherry on top, a $5 billion joint venture investment from NVIDIA for data center solutions.
$5 billion.
NVIDIA. The undisputed king of the current AI boom is investing $5 billion into an Intel joint venture.
You have to consider the mechanics of why NVIDIA would do that, though. NVIDIA designs chips, but they don't manufacture them. They rely heavily on foundries in Taiwan.
Right, TSMC.
Yes. By investing $5 billion into Intel, NVIDIA is actively funding the diversification of its own supply chain. When Amazon, Tesla, and NVIDIA are handing you contracts and capital, they are not doing it out of charity.
Definitely not.
They've looked under the hood of that 18A process, and they believe Intel has the capability to execute.
Let me frame it this way. Think about this entire situation like a high-stakes poker game. Intel has been on a brutal losing streak for years. Their chip stack was getting incredibly low, the other players were dominating the table, and everyone assumed Intel was about to bust out.
Yep, that was the sentiment.
But suddenly, NVIDIA, the wealthiest player at the table, just slid $5 billion in chips across the felt to keep Intel in the game. It is still risky. Intel still has to play the cards right, build the factories, and execute the 18A ramp-up.
They still have to win the hands.
Right. But with that kind of financial backing and guaranteed client demand, the upside is enormous. They aren't just surviving, they are being actively positioned to win by the biggest tech companies in the world.
That captures the market dynamics perfectly. So if we synthesize everything we've covered, we're left analyzing two very distinct timelines.
Okay, what's the short term look like?
In the short term, this is a dangerous environment characterized by extreme greed. The stock is technically overextended, flashing that 73.3 RSI warning. Retail interest is surging, creating a vulnerable FOMO environment.
Fear of missing out is real right now.
Very real. And given the surprisingly weak Q1 revenue guidance, a period of choppy, sideways consolidation is highly probable as the market demands proof of execution.
But the long-term perspective?
The long-term perspective is a totally different equation. If they execute the 18A manufacturing ramp-up without delays, and if they fulfill these mega deals with AWS, Tesla, and NVIDIA, then we are witnessing a legitimate historic turnaround. It would solidify Intel not just as a legacy computer brand, but as the foundational manufacturing bedrock of the next generation of artificial intelligence hardware.
So we have the short-term technical indicators warning of an imminent pullback, and the long-term fundamentals whispering about an unprecedented corporate renaissance. And you, the listener, don't have to wait very long to see which force ultimately wins the tug of war.
Not long at all.
The true proving ground is just days away. Intel reports its Q1 2026 earnings on April 23, 2026. Put that date on your calendar. That earnings call is going to be the absolute driver for the next major price move.
It's the catalyst.
Management will either prove that their light $12.2 billion guidance was just them being conservative, or they will confirm the analysts' darkest fears.
The broader market, the institutional options traders, and the fundamental analysts will all be scrutinizing every single syllable of management's commentary regarding the foundry cash burn and the timeline for those AWS and NVIDIA partnerships.
Exactly. So here is what I want to leave you with today. We have retail greed pushing a stock up 70%. We have an overbought technical signal flashing bright red. We have professional Wall Street analysts predicting a 22% collapse.
A lot of bearish signals.
But we also have institutional whales buying up massive call blocks and NVIDIA handing over $5 billion to secure future manufacturing. When those earnings drop on April 23rd, will the smart money that bought those call options be cashing in on a historic payday? Or will retail traders be left holding the bag on a brilliantly disguised value trap?
It's going to be wild to watch.
And consider this final thought to mull over. If Intel actually pulls off this 18A turnaround and successfully becomes the go-to manufacturer for advanced AI chips right here on American soil, what happens to the geopolitical premium currently baked into the stock price of overseas manufacturers like TSMC?
Oh, that's a massive question.
If the global tech supply chain no longer relies entirely on a single island in the Pacific, the domino effect across the entire semiconductor sector will be staggering. That is a shift worth keeping your eyes on. We will see you next time.